welcome to Pricing College with your hosts, Joanna Wells
and Aidan Campbell.
Okay, so today we're going to talk about a slightly different economic topic on like bubbles, but bubbles in housing, bubbles in IT, all those sorts of things. And we're going to just talk a little bit about kind of why they're not really talked about in pricing. Sometimes they are in certain industries, and just go into a little bit more detail about them.
And really explain why we don't generally cover bubbles or pricing speculation or those sort of things on our podcast. And I suppose fundamentally the reason is that we specialize in pricing product services to either B2B or B2C consumers. Generally not, we don't really focus on investments whereby, you think a product that you buy today for $100 will go up to $500 in the future, or even as a store value that it might maintain its value over time. So that's not really where we focus. Obviously, there still is a transaction, a purchase, but you're not really buying that item, that share, that dividend, whatever it is, that commodity for the usage of it or the value you place on it. You're buying it for potentially keeping it in your portfolio, selling it later, and hoping it increases in price.
Yeah, at the same time, bubbles has some kind of human element to it in terms of its relationship with consumer confidence, consumer demand, supply and demand. So there is that sort of I suppose general theme with bubbles that it's still related to human beings, but at the same time it's really quite hard to measure as a price setting metric, or even as something that you can tangibly use to set prices for products and services. Yet in the real estate industry, that people follow bubbles as one leading indicator of where the market's going. So it's not something, that we completely ignore, but it's still, for like products and services in B2B, B2C, it's still not really useful enough to determine as a metric.
Yeah, I think there is definitely an overlap in the psychology of pricing in any aspect and the psychology of bubbles also. Generally in bubbles where we're talking about speculation, where that's a Dutch tulip mania, the Japanese property bubble in the late 80s, or anything else, it's generally, based on some aspect of some shortage or perceived shortage, some increase in demand, and also people say just a mass market belief that it's going to increase, where that's supported by media coverage, cheap money through very low interest rates or something along those lines, that's pushing people to think things that happened yesterday will continue in the future. Obviously, with these sort of bubbles and speculations, when they get to the end, often the price increase can accelerate, because people want that increasing acceleration in price to almost outweigh the perceived risk, as obviously when prices get higher, the risk of them collapsing increases also. But the psychological aspect of what people look at, there certainly is overlap in that regards. I suppose in our podcasts and blogs and different content, we generally focus on, products that are, tangible usage or some sort of usage to the customer, whereby the value the customer places on them is actually in line with the price they pay, and whereas in speculation and bubbles, I think I'd make the differentiation that the price people pay is fundamentally, there's no other tangible benefit to it in many cases. Think of buying a share in one of the big four banks. There's no real value in having it except for the actual price. So the price and the price are the same. The value and the price are fundamentally the same thing in a market-to-market environment. So it really defeats the entire point of advertising, marketing, value culture, those sort of aspects.
Yeah, I think when there's a bubble, there's some kind of, I think people like to relate the bubble to the price, and I'm just thinking here in terms of real estate. When there's a bubble, you see prices going up, and people think of that as a direct correlation between, or a direct link between the two. And actually, it's more just of a correlation. So when there's, for instance, a bubble, a speculated bubble in the housing market, you'll see more activity in pricing. There'll be more variation in prices. Prices tend to go up, and also there's more like bids and auctions as opposed to direct sales through the real estate agent. When there's speculation, for instance, that the bubbles burst, what happens is that obviously less variation in price, everyone's more nervous, consumer sentiment goes down, and real estate agents tend to do sort of more direct selling. You even get them, cold calling more. The bids and all the auctions are closed. The pricing becomes more secretive. And I think because of that sort of relationship between a bubble and pricing, especially in the real estate industry, people think there's a direct link, but it's actually it's more, again, on that myth-like sort of just a correlation. It's speculation, it's more confusion, and people leading really, I suppose, with their gut as opposed to any evidence. And that's still quite relevant in a lot of industries. But a lot of pricing, especially in the real estate industry, when it's related to that bubble type of concept, it becomes very much guesswork and gut feel.
The other thing I would say is very often you'll hear in the popular press or even just people talking, they'll call things bubbles when in reality they're not a bubble at all. Prices can increase in short periods of time, and there's very often real value-based pricing reasons for that. Super Bowl Sunday, if it's in, say, Miami, hotel prices will increase for the weekend before that game, and that's perfectly understandable. Just because they've increased, it doesn't mean there's a bubble in them. Unless the only way it could be a bubble in theory would be if people were booking the rooms and then subletting them or renting them out to somebody else in a secondary market prior to that, which you could happen in scalping for tickets to sports events and those sort of things. The other thing I'd say is the press in Australia and I believe other countries has covered a real increase in prices for puppies recently during the whole COVID crisis. Prices for dogs have gone through the roof for certain suitable dogs that can live in cities and in apartments, etc. Is there a logical reason for that to happen? Yes, of course there is. People are stuck at home. There's a lot of people lonely. There's a lot of people looking for company, and obviously dogs are actually they're a real living animal. So you can't produce infinite amount of dogs one week and then much lower amounts the next. So it's very much a demand driven increase in a commodity or a capacity constrained environment, really.
So in a way, people's discussion of bubbles is almost a misunderstanding of supply and demand. It has a mythical status for lay people who potentially don't know as much as pricing experts about the dynamics between supply and demand, customer demand driving up, various industries, various products, and then there's a decline. Pricing people know that, they make money out of it, they do yield management and such like. But I suppose, maybe other industries aren't as sophisticated in their pricing knowledge, and then they use this sort of bubble, the soothsaying sort of mythical bubble as an explanation for price increases and consumer demand. It could possibly be that.
I think we'll probably wrap this one up. I don't think, in general terms, our podcast is not focused on pricing areas such as stock valuation. It's not focused on derivative valuations. You'll see job ads, and you'll probably see as many job ads for pricing people in banks. There's a very different skill set. It's very much more a valuation based aspect, looking at should you invest in companies, etc., which is a very different thing than what we talk about. We have mentioned Warren Buffett on some of the previous podcasts that when he looks at a company, he looks to see the pricing power of the business. So even the best investors are looking at the pricing capability that a company has. That's obviously different to them. That will help them form the valuation for the company that they later have. But the pricing they're looking at is a very different aspect, and I think we should keep that in mind.
Yeah, I think that's about it this week on that. Okay, thanks for listening.
Have a great week. Bye.